Assalamualaikum warahmatullahi wabarakatuh. My name is Clara Eduna Diwidya. My metric number is 702082. I'm about to present my study analysis in Bank Mandiri, which is the determinants of factor affecting liquidity risk. So the overview of Bank Mandiri was founded as a part of the banking reform program initiated by the Indonesian government in July 1999 for state banks, which were Bank Bumidaya, Bank Dagang Negara, Bank Ekspor-Impor Indonesia, and Bank Pembangunan Indonesia were consolidated into Bank Mandiri. Bank Mandiri manifested four main strategies, which were cultural implementation, aggressive NPL level control, increasing the average business growth, and developing and managing the Alliance program. Their long-term vision is to be the best bank in Asia by 2020, and they focus on three main areas, which are improving wholesale market leadership by enhancing customer relationships, to become the bank of choice in the customer in the retail segment, and integrating business in all existing segments. The problem statement here is liquidity risk is the threat of a company of organization being able to meet short-term financial obligation because of the inability to transform assets into cash without incurring a loss. Liquidity risk arises when, in order to satisfy financial obligation, a company of a person retains an asset that they wish to sell, but without selling it below in market value, they cannot do so. The reason this might happen are inefficient markets, limited cash flow, market structure, asset type, urgency, and market condition. In banking sector, banks welcome customer deposits and use those funds to provide other customers with loans such as mortgage, student loans, and personal loans. The research objectives here are first, to discover internal factors that can affect liquidity risk. Second, to recognize external factors that can affect liquidity risk. And the third one is to analyze internal and external factors that may have an impact on liquidity risk. For the research question is, first, is there any correlation between internal factors and liquidity risk? The second one is there any correlation between external factors and liquidity risk? And the third one, is there any correlation between internal and external factors to liquidity risk? The literature review. Financial risk is an opportunity that the parties involved will end up losing their money. It also states that only downside risk is included, implying the potential of financial loss and confusion about its scale. Liquidity risk is a prospective threat for an organization not to prepare the funds needed to achieve short-term or moderate-term allegiance. While credit risk is the risk of a default on a loan that may have resulted from the inability of a borrower to make the payment demanded. The aim is to enhance a bank's risk-adjusted return rate by ensuring credit risk exposure within relevant restriction. Operational risk is a risk of a value changes due to the fact that real losses incurred due to insufficient or inadequate internal procedures, persons, and systems, or external occurrences. Profitability is the revenues. So there's a revenues and expenses are the two main factors of profitability. Profitability explores the connection among revenues and expenses to see how well the business performs and also to see the future for the business. Corporate governance is a wide concept that defines the practices, the customs, rules, laws, and institutions that steer organizations and business in the way they function, conduct, and synchronize their activities. So the design and methodology that's used in this here is the sample data used is Bank Mandiri Annual Financial Report from 2015 to 2019. The dependent variable used is liquidity risk, while the independent variables for the internal one is CGI index, ROA, and average collection period. And for the external one is GDP, interest rate, and inflation rate. Also, the study analysis used statistical package for social sciences, or known as SPSS, to analyze the data. So here's the model summary. The independent variable is GDP, interest rate, and inflation rate, while the dependent variables is current ratio. So the R square here is 0.481, which has very small error of 0.014. The Durbin-Watson score is 2.6, which is comply with the rule. The rule is 1 is bigger than 1.5 but lower than 3.0. The ANOVA here, also the dependent and the independent are the same. The p-value is 0.830 is not significant enough because the rule is p must be under 0.1. The descriptive analysis here, also interest rate, inflation rate, and GDP. The mean here for interest rate is 5.5, for inflation rate is 3.9, and for GDP is 5.0. For correlation here, the positive, the one that have positive correlated is interest rate and GDP. GDP has a weak significance level, while interest rate has no significance level since it is bigger than 0.1. And for the negative one is only inflation rate, which is minus 0.2. For the coefficient, all the independents have no huge impact because it's all bigger than 0.1. So the conclusion here is the only GDP cause weak negative influence toward liquidity risk as shown in the correlation before. Since most of the independent variables p-value is not significant enough like the rule suppose. So most of them are bigger than 0.1. So it's a positive one, but it doesn't have that much significance toward the liquidity risk. The recommendation here is to change the internal factors, increase the CZ index by developing more good corporate governance practices, and increase GDP to give stronger influence towards the liquidity risk. That's all for my presentation. Thank you so much. Wassalamualaikum warahmatullahi wabarakatuh.